Good afternoon, everybody, and it's a pleasure to have this time with you. Got James next to me, our CFO, and really happy to take you through what we feel are a really robust set of results in the current market. And the underlying theme that you'll pick up today as we go through these results is in and around the strength and positioning of our market-leading brands, really strong new product development activity, and increased cohesion and work between our different brands to drive organic market share growth. So we delivered a record UK performance. South Africa, a little bit more difficult in and around power interruptions. Those have subsided, and we expect the market to normalize and gradually grow back. Revenue of £201 million for the half. Underlying operating profit at 21.4, net debt at just around 1 times EBITDA, and we've managed to hold our interim dividend. I think what's also really strong in terms of these results is really excellent cash generation, which is something that we've done consistently over the last 10 years, and towards the back of the deck in the appendix you can have a look at our track record. The really good progress in terms of the refinements and execution of our strategic priorities is paying dividends, and looking forward, full year underlying operating profit is expected to be in line with market expectations. James, I don't know if there's anything you'd like to add to that.
Not yet.
Okay, flip to the next slide. We really operate in 2 core markets and have operated in both of these markets for a very long time. We understand them very well, and we have market-leading brands in both sectors. As I said earlier, our UK business delivered a record underlying operating profit of 18.7 million. We believe we've outperformed the market, and we'll talk just now in and around the reasons why that might be. Outperformance from our Triton and Merlin brands, and as I said earlier, very, very strong new product development programs and excellent service levels have driven those share gains. On the South African side, tougher. We had significant energy challenges earlier in the year. Those impacted the start of the new building cycle in South Africa, which ran from sort of February, March to October, November. So we've missed the new build cycle for this year, but expect that to kick back off early next year on the back of improved energy supply. We have really strong brands out in South Africa. We have a mini Norcros out there. So you've got a James and Thomas managing 4 businesses with full management teams there. We have no debt in South Africa and generate good profits and good cash. Next slide, please. This is a really important slide in terms of understanding Norcros and specifically our UK position. And you can see in the title at the top, we talk to a more resilient mid to premium RMI segment. On the left-hand side, you have a breakdown of where the demand for bathroom and kitchen products comes from. And what you can see in the gold segment of the left-hand pie is around 80% of current demand currently comes from RMI, with new house build being 13%. That can move up and down, but as things stand, that would give you a good indication of where demand is coming from. In terms of the product markets that we operate in, on a good, better, best, or economy, middle, upper, premium, the Norcros brands all sit in the 2 blue segments, which in the mid to premium segment. I think what helps distinguish the Norcros brands is that we differentiated from other building commodities like cement, roof trusses, and we are not dependent on new build for our volume. You can click again. James.
Thanks very much, Thomas. If you go to just slide number 6, I'll just take you through some of the numbers. I'll point out some of the high-level important parts of this, and we can take any detailed questions in Q&A later. Just on slide number 6, as Thomas mentioned, revenue for the half, 201.6 million, and an underlying operating profit of 21.4 million. That was just below the record half year from the prior year. If we go on to slide number 7, please, Andy, we'll just go into some of the detail there in the 2 regions we focus on, the UK and South Africa. Probably easiest to focus on the 2 bottom charts. The bottom left shows the revenue in the UK, which despite tough market conditions, increased by 0.8% to 143.9 million. South Africa revenue decreased to 57.7, largely due to the headwinds from the energy restrictions, which Thomas mentioned before. In the UK, underlying operating profit was 18.7 million, and that represented a record performance and a return on sales of 13%, up from the 11.4% in the half from the prior year. South African profit was at 2.7 million. And overall return on sales for the group was 21.4 million at 10.6%. Next slide, please, Andy. So just looking here at earnings, dividends and tax, I think the two call-out points here are firstly, EPS at 15.6 pence, marginally behind the prior year due to the interest cost from the bank debt that was used to acquire our last business, which was Grant Westfield in 2022. But despite that, the dividend per share was maintained, the interim dividend at 3.4 pence, and that represents and reflects our confidence in the prospects of our business going forward. Next slide, please, Andy. So this is something Thomas alluded to before. I think that's a detailed slide with all our cash elements on, but the number I want to focus on is just that 121% towards the middle of the slide. That's a great performance in the half, but that's representative of what we do in terms of cash management at our group. Over the last 10 years, that has historically been at 80–90% plus. We're a very cash-focused business, and as you can see, we generate decent cash, and which has helped us reduce leverage in the past, and will do so going forward. Next slide, please, Andy. So you can see that we've got an exceptionally strong balance sheet. Debt at 46.6 million, that's coming down nicely. Leverage is just under 1x. We've got a bank facility that we've recently extended for a year through to 2026, and that's 130 million RCF with 70 million accordion. And that gives us significant liquidity and funding headroom. On the right-hand side of that chart, you'll see we have a legacy DB accounting scheme that's super mature, but that is in an accounting surplus and remains in an accounting surplus at 15.7 million at the half year. Thomas, back to you.
Thanks, James. And if we could just click to the next slide then, please. In June 23, we highlighted 4 key strategic priorities for the group. Those being portfolio development, our drive in terms of growing organic market share growth, a real strong focus on operational excellence, and ESG as a competitive advantage, understanding what a broad umbrella that is. I'm pleased to report that we made excellent progress refining and in terms of the early execution of these strategic priorities, and we'll talk to that on the next slide. So if we look at portfolio development, Norcros has been a collection of brands over a significant while now. James, in fact, led the acquisition program that has got us to where we are with 11 really strong brands in the business. We've generally had brands coming in and nothing going out, and we are now focused on the performance of those individual brands, specifically looking at operating margin and the return on capital employed. And if we feel that we are not able to add value to a business or a brand or grow it, then we'll look to exit it. And we have done what we said we'd do in the first half. We've exited our UK adhesives business. We did that to plan and completed it successfully. We are currently reducing the manufacturing capacity at Johnson Tiles in the UK. And we also have a very well-developed acquisition pipeline. Our acquisition pipeline is both on-market and off-market. We are seen as a natural home to many people wanting to sell their businesses. And we have an excellent track record in terms of the businesses we select and our ability to grow those businesses. The second key focus area, and I think in the current market this is really important, is organic growth. I've alluded to earlier, we've a really strong new product development program. 25% of our products are 25% of the products we sell are products that have been launched in the last 3 years. Those products increasingly have strong sustainability credentials, and we have a great pipeline going forward. We have also leveraged the opportunity to cross-sell, and that is not each of the brands selling each other's brands, but rather introducing them to each other's businesses. And by way of example, our recent acquisition, Grant Westfield, we've introduced them to Screwfix, Wicks, and Tops. That's exactly what we did when we brought Merlin on, and we doubled the size of Merlin from 2017 until now. So proven track record of bringing businesses on and growing them. To the earlier point, we've got market-leading brands in the more resilient RMI market segments, and a number of those brands are market leaders. Triton, Grant Westfield, Merlin are all clear number one players in the markets that they operate in. Big focus on operational excellence and growing cost and revenue synergies as we've scaled up. On the cost side, we've done remarkably well on freight by pooling our freight. We've done well on the sales side, as discussed earlier, and we are investing further in our customer service capabilities and also simplifying our warehousing and logistics to drive further efficiencies there as well. On the ESG side, our carbon targets are currently being validated by SBTi, and I think it's really important to note we see this whole ESG umbrella as a key part and a core part of our strategy going forward. The products that we're launching, the growth that we're starting to pick up is strongly linked to the sustainability credentials of the products that we sell. You'll see the word engaged supplier status at the second bullet point there. And what that refers to is our ability to work with our partners, be it a Travis Perkins or a Wicks, and become a preferred partner because of our strong ESG credentials. Included in those credentials is our ability to supply really critical data for their own ESG programs in the format that they want. And that makes us a much more resilient partner and much more valued as well. Importantly, we have appointed a chief people officer into the group, and although we run a decentralized model, we understand the importance of talent going forward and future-proofing our business, and have taken early but important first steps in this regard. You can click. I think what's also important is to understand the size of the opportunity for Norcros, regardless of where we are in the market cycle. We've grown by consolidating what are fragmented and very attractive kitchen and bathroom product markets. And if you look at this puzzle, it's a famous puzzle within Norcros. In the gold, you can have a look at the businesses that we currently own, and in the blue, you can have a look at the adjacent segments that would be of great interest to us. We continue to look at these really carefully. We're really sensible about making acquisitions. We spend a long time researching any businesses that we buy, and we've got a proven track record growing those businesses. Thanks, Andy. By way of new product development, those of you that know Triton would remember that Triton is an electric shower that you generally see a white box on the wall. Our in-house design capabilities, and every one of our businesses has a specialist design team working within the business. So we're not a distributor. We don't buy other people's products. We design our own. But what we've done, and this is potentially a game-changing product, is we've launched the first behind-the-wall electric shower that looks exactly like a normal mixer. So this new Envy shower by Triton has the mechanics of the shower sitting either in the wall, in the roof, or in a cupboard, and no longer stuck on the wall of your shower. It has excellent sustainability credentials, both in terms of being cheaper to have a shower than with a boiler shower. It is our first Climate Partner certified product, so it's carbon neutral, and again has very, very strong upside in terms of the future home standard. And this is the kind of product that typifies where Norcros is going. Thank you, Andy. If you have a look at our key customer base, we are very specific about not just chasing revenue, and you'll have a look at down near the bottom, our DIY retail. A very small part of our business comes from big box retailers. We have a huge focus on carefully selected trade and specification, and also independent customers. This is a blue chip customer base. It is stable, and when it grows because we feel that we can find a partner that understands our brands, the hierarchy of our brands, and how to position them. So very, very careful who we do business with, and long-standing relationships in these channels. Thanks. Talking again to the fragmented nature of the markets, when you look at these bar charts, the light color signifies the market share held by the leading players in that market, including ourselves. So if you were looking at Triton and electric showers, the two main players are ourselves and Myra. We are the number one in terms of market share and have north of 50% of the electric shower market share in the UK. When you look across to the right and you go into enclosures and trays, again, Merlin is the number one shower enclosure business in the UK and Ireland. You can see that although the market share is at 25%, there's a huge amount to go at. And that same story replicates across brassware, wall coverings, and furniture accessories. We have some clear gaps in terms of bathroom furniture, baths, and sanitary ware in the UK. We do these and supply into these segments in South Africa. So we are able to enter those markets either organically or through M&A. So there's significant opportunity to take further share in these fragmented markets. Thanks, Andy. The story is replicated in South Africa, and I think the important thing to take away from this slide is, again, the size of the markets in South Africa. If you have a look on the right-hand side, you can see the size of the three markets that we cover in South Africa is 1.6 billion UK pounds. And that really talks only to the formal market in South Africa. There is a very large informal market that is not captured. So lots of opportunity for further organic growth in South Africa. And we continue to take share from smaller and weaker competitors. Thanks, Andy. We've touched on ESG, so I'm not going to spend a huge amount of time here. We've made excellent progress. Our carbon targets are being validated by SBTi. We've made our first disclosures to CDP. 4 of our businesses are already carbon neutral, and we started launching products like the Envy that I've just taken you through, which is our first carbon neutral product. So we are very proud of where we are in terms of the wide and broad umbrella that is ESG, and we continue to believe that this will be a key part of driving market share growth going forward. So in summary and looking forward, a robust performance reflecting the strength and positioning of our market-leading brands. And I think that's really important. We're not as cyclical as a number of our peers. We are not a commodity business. We're not a distributor. We design in-house. We supply products to selected partners who know how to position our brands, and we are able to grow market share profitably. We've made really good progress on our strategic priorities by closing our adhesive business in the UK. We have driven our new product development to really drive organic share gains, and our pipeline remains strong. As I mentioned, ESG is driving a strong competitive advantage for us and will continue to do so. Our cash flow is excellent and will continue to be that way. And we have, for those of you who don't know us that well, we take a very conservative view when it comes to debt and leverage, be that when we're doing M&A or just generally running the business, and that will continue. We have an excellent platform for further growth as we continue to consolidate what are large and fragmented bathroom and kitchen product markets. Our approach is all about being design-led and supply of sustainable products. And we believe that the benefit of our scale and the strength of our balance sheet, our brilliant and really, truly excellent new product development capabilities means we'll continue to take share from the weaker competition, both in the UK and South Africa. Our full-year underlying profit expectations will remain in line with market expectations. And I think that's quite important, quite different to a lot of businesses that have recently released their results.
Just before we go to Q&A, perhaps go forward 2 more slides to 23.
Yep.
I just think it's worth highlighting the 10-year track record of the business. And but obviously that's through arguably some difficult, tough markets in the UK and South Africa. But you can see how the revenue has grown. The underlying operating profit performance, that's been strong. The return on capital employed consistently above 15%. And the cash conversion there, absolutely excellent. You can see FY21 as we squeezed working capital during the pandemic, and that came back again at FY22. So we averaged those two out. And so through the cycle, we've delivered a really good set of results, and I think that's an important attribute to the Norcros story. Thanks, Andy.
Where else could we start but South Africa? So actually one for you, James. A couple of questions on cash repatriation. Are there any currency control issues that you have to deal with? And then the second part of the question is, has there been any return of net funds from the South African unit to the UK parents in the last 2 or 3 years?
Good question, one we get asked often. And I think the point being is it is a well-worn path to bring cash back from South Africa. You have to get local bank approval, which is a relatively straightforward thing to do. We brought cash back a month or two ago, and we just leave in South Africa sufficient cash to fund working capital. I think what we would say is we've never put cash into South Africa either. It makes cash, it generates cash, and just to be explicit, we can take cash out easily.
Okay, thank you. And then definitely one for Thomas, looking more at the macro environment. Can you give the audience a feel for how resilient the South African economy and individual businesses have become with respect to the problems of load shedding, which are by no means new developments in South Africa?
No, I mean, we've had load shedding for as long as I can remember, and it's a planned thing. In normal times, you might have 2 episodes of load shedding in a week for 2 to 3 hours. It's well communicated, and it happens when it's supposed to. All of our businesses have backup energy. What unfortunately happened at the back end of Q4 and the beginning of Q1 is we had a couple of things come together that really knocked our energy supply hard, and we went out to sort of 10 to 12 hours of load shedding a day, which is a bit of a showstopper. It's essentially been a once-off. It's the only time that I can recall it happening, and you can hear from my accent that I come from South Africa. What we have seen is a strong recovery in terms of the energy availability. We're seeing increased private sector supply coming onto the grid. And if you just think about South Africa, we've got lots of wind on the east coast and lots of sun and deserts in the middle of South Africa. So lots of solar going in. I see a pretty clear path over the next 18 to 24 months in terms of the private sector mix in terms of energy supply and stability of energy supply. We may have a few hiccups along the way, but those hiccups wouldn't be, unless they are the size that happened now 6 months ago now, that they just don't impact economic activity in South Africa. So that would be really how we would look at it. That said, we expect the recovery in South Africa to be measured because we've missed the new build cycle. That load shedding happened at the beginning. It's an annual cycle starting in February, March, ending in October. So expect new build to kick off early next year, and RMI to kick off just a little bit ahead of that.
Okay, and that's a neat segue into next question. Assuming we do gradually get a more normalized energy market in South Africa, what do you think that might mean for profit margins in the region for you?
Traditionally, we've got up to around 7% in terms of our profit margin, James.
Yes, 7-8% historically, and I think Thomas, you carry on.
We'll work our way back to it. The speed we get back there, I think, will really be determined by exactly what we've been talking about, whether we're right or not on the energy side. I mean, South Africa's got 80 million people living in there, young population, shortage of housing and infrastructure. And if you just go back a year or two, we made £10 million a year and have been sending cash back to the UK. We have no debt in South Africa. So around 7% we'd like to get back to in fairly quick order, and generating cash as we were and repatriating that cash. We don't intend making any significant investments in capital projects like new tile manufacturing capacity. So it's really working with what we've got in South Africa largely.
Okay, and the last one on that point, what is your medium to longer term plan for growing the House of Plumbing?
It's really about a national footprint. So House of Plumbing is a regional business up in Gauteng. And we're looking firstly to get a national footprint using the existing model, which is a very heavily commercially focused model. So that business specializes in costing and supplying into large commercial products. Given that is a weaker segment of the economy at the moment, we have a secondary strand of growth. We were looking to address the maintenance plumbing markets. So it's really about national footprint and filling the gaps on the maintenance side as well. So, a lot of opportunity in terms of growth for House of Plumbing going forward.
Okay, right. Geographically, we're going to head north and east a little bit. We have a question. You have distributor arrangements with the likes of Al Shire within the Middle East.
Yep.
Are there any opportunities that you are seeing in Saudi Arabia, given their vast infrastructure developments?
Yeah, I think anybody who's operating in the Gulf is extremely focused on Saudi Arabia. So yes, we do. We're fairly well represented, got a long history in the Gulf, and have increased our investment and resources in the Gulf, and looking to take advantage of the growth there. We believe that the Gulf will grow. Been quite a lot of changes in places like Dubai, for instance, where you can now, when you finish working, stay there. So you've got a relatively rich market that is putting its roots down, and I think it'll deliver sustainable growth going forward.
Okay, now we'll take you a big step eastwards. So we've got a question on China, which is a strong area for your sourcing and your supply chain. Yep. Can you say approximately what percentage of Ultimate Group revenues represent products that are sourced from China? And given that there are quite often political tensions regarding this region, what alternative plans might you have if there was a severe deterioration?
I think it's just north of 50% of our revenue comes from products directly sourced from China, or UK revenue, or components that come from China to, say, Triton, where we do light assembly. In saying that, we have a long history in China. We have in excess of 30 permanent staff members in China, over 120 factories. We view them as key strategic partners, and going through things like COVID, our ability to leverage those relationships really helped us outperform the market in terms of our stock levels and our service levels. The geopolitical concerns I'll address in two ways. Firstly, pretty much any factory in the world making anything has a component from China in it. So you might be making something in Italy and there'll be one widget, as the car guys found out, that comes from elsewhere. So nobody should get too comfortable about being completely resilient to any shocks out of China. But in saying that, we have backup and secondary plants in Europe, specifically. We were growing quite a strong presence in Eastern Europe. The Ukraine hasn't helped that. The Ukraine's not just about grain. A lot of our wire harnesses, for instance, came from Ukraine. And we will continue to develop Eastern Europe, into Turkey, and we think going forward North Africa, given its close proximity, will become increasingly important. So big focus for any business, but also a reality in terms of how we deal with it.
Right, well said. And last question on politics, I think. Going back to South Africa, can you describe how involved you are within the Black empowerment movements there?
Yes. So it's a fairly complicated setup, and it's legislated. The piece that we probably struggle a little bit with is there's a large ownership component in your Black empowerment ratings. But in all other areas that make up that rating, we do an exceptional job. And, that's in terms of things like training and development, community development. I mean, our signature community project is building with our staff safe toilets in rural areas. And if you go into our annual financial statements, you'll be able to see examples of that. So exceptionally strong contributors to society. We're at a level that allows us to compete, but doesn't get us to the front of the pack. And will remain in the position we're in at the moment. We think it's sufficient.
I think short of changing our ownership structure, we've got the full marks.
Okay, taken as granted. Right, swinging back to the UK. Is Johnson Tiles losing market share at the moment? Someone asked.
No, it's in fact, I think, taken market share. And if you have a look at the positions that we're strong in, we continue to take share. We have deliberately moved away from less profitable business, and that's been part of the Norcros story over the last 10 years across a number of our businesses. So we used to do a lot of businesses, a lot of Johnson's business in the big boxes, very hard to generate a decent profit there. So our focus has been on house builders and fixers, specialty retail. And if you have a look at the product that goes in there, some really world-beating products. So although we don't sell as much as we used to, it's a conscious effort to exit low-yielding product that made no sense being involved in, really.
Okay, a couple of questions on Grant Westfield. First, the easy one. Is it fully integrated now?
It certainly is. It's a cracking business. It's a cracking business in a growing market segment. And if you haven't heard about premium wall panels, you're going to hear about them in the next 2 years. We're the market leaders. We have 40% of the UK market, and continue to grow. We, as I've said, integrating it into Norcros has had the benefits of getting it into Screwfix, Wicks, and Tops in fairly quick order. We have an excellent new product development team, and the integration, again, and this is the benefit of having multiple brands. They're working very, very closely with the Triton management team, who helping them find their place in the business, but feels like they've been here forever, really. So really pleased with the acquisition, and we believe it'll be one of the major growth drivers. And again, if you go into the pack, we've got the Merlin slide. If you go to slide 28 for us, Andy, just to illustrate what we do and what's already happening at Grant Westfield. Merlin was no different to Grant Westfield. I think, as I said earlier, we brought it in, introduced it to new channels, and doubled the size of the business. Merlin was the acquisition we did just prior to Grant Westfield. You can see we brought it in FY17, and by FY23, essentially doubled the size of the business. And that came from cross-selling, introducing them to existing group customers. And to be fair, they introduced us to some customers as well. So, that ability to collaborate and work together accelerates the growth and accelerates our organic market share. So we expect Grant Westfield to be no different to the Merlin experience.
Okay, I'm going to leave that slide up actually for a second or two. So a couple of questions specifically on Grant Westfield again. Are you happy with the progress you're making with the major house builders, as you do have a later slide, which is only showing Grant Westfield penetrating one of the top 10?
Yeah, very early progress. But if you think of the new house build standard coming in 2025, where you've got to have a 75% carbon reduction in a new house build, this is essentially a fully recyclable product. And in the manufacturing process, you also pretty much use any waste coming out of that process in biofuel. It's a very easy product to install, and lends itself to future builds. So we are testing, we are trialing, and I expect us to make significant progress in the house builders going forward. James?
There's a particular reason why Grant Westfield on that slide has only one account win. That's with Barratt's. That's because the opportunities with Grant Westfield have been quite considerable, and we've had to prioritise. So Grant Westfield has prioritised and has been introduced and is currently listed in Wicks, in Tops Tiles, and in Screwfix. And we've just got to be a little bit careful that they don't get stretched too thinly with these great multi-million-pound opportunities. But as Thomas said, house building, yeah, we're on it, and we'll get onto that very, very soon. But we want to make sure that Grant Westfield prioritise accordingly.
And I mean, outside of house builders as well, and to James's point, we have one big commercial hotel chain as well that we are in. You can imagine we can turn around a bathroom using these panels in a day or two, as opposed to tiles where you had to chip them off, retile, regrout. So that ability to turn around key commercial spaces really quickly is another great thing. But I think to James's point, very important. We did the same with Merlin. We do it in a measured way. We make sure we can keep our promises to our customers and deliver what we say we're going to do. And we just don't shotgun stuff.
Sticking on the UK house building theme, we have a question. I'm sure you would never set your strategy to adapt to UK politics, which can be a bit unpredictable. But it does seem highly likely that we're going to get a change of government in the next year. So are you comfortable, given that the Labour Party is committing to a lot more new build, that you're in a good position should that occur?
Yeah, we've got market leading positions in the house builders, excellent relationships with our customers, both at a national level and regional level. And I think regardless of who's in power, there's a shortage of houses. And we're very, very well positioned to support and help those house builders as that starts coming through. So we see that as a strong area of revenue growth going forward.
And if you link that as well with a shortage of skills, particularly say with tiling is quite a difficult thing to do well. That lends itself to our products where it's easy fix, easy to do. A joiner could fix the panel. Some of our brassware, that's easy fix, and some of our Merlin enclosures, that's easy, quick fix as well. Trying to help the installer is also an important attribute to a lot of our products.
Yeah.
Okay, great. Now, last question specifically on the UK, where things are going well and margins are pretty much at record levels. So what might we from the outside see as a new normal range for margins in the UK in coming years?
Yeah, very pleased with that margin development in the UK in the first half at 13%. I think that would be fine to assume that as a new baseline for Norcros UK. I think that has benefited from the Grant Westfield business coming into the portfolio, which has got strong EBIT margins, and the exit of the adhesives business, which had not so strong EBIT margins. I think going forward, there's also room for improvement, and clearly we're on that through the strategy review on what businesses we want to work on and how we can improve that further. So I hope there's more to come, but 13% is definitely the new normal.
Okay, good to hear. Right, bigger perspective questions on the group. You were investing in IT very sensibly, but can you give a little more detail on how you're aligning a number of IT platforms across a diverse group?
What's important, we run a decentralized model. So, what you're not going to see from Norcros is some big major SAP installation. I think, we see ERP, and we do invest in our ERP as just a core piece of software. The magic comes from the apps and the stuff around that, right? So our investment is really about the customer experience, making sure it's really easy for our customers to engage, for our staff to engage with our customers, and specifically to support our B2B customers as they manage what has become a more fragmented route to market, be it their normal customer, be it marketplace, be it D2C. Data is hugely important in that process. So a lot of our investments going into simplifying it, making it easier for people to transact in a way that's comfortable with so that's really where it's at, and that'll be ongoing.
Okay, and in terms of operational excellence and cost efficiency, how much more scope is there for taking cost out or sharing more the cost of services within the group? And I think you mentioned distribution as a positive example. Is there more to come?
There is, but sensibly, the strength of our model is we have, sector specialists running our business with great relationships backwards on the supply side and forward. So when we're looking for opportunities here, we do that keeping in mind that we, quite often businesses on a spreadsheet look great. You add one and one together and you end up with two. But in sales and places like that, it's often 1.5 because they prefer selling something else. But in saying that, we move a lot of stock around. We've got numerous facilities, and we believe that there is a fair amount of value still to be had by simplifying what we do and how we move stuff around. So yeah, Andy, the answer is there's more upside.
Okay, great. And looking forward, a couple of questions about synergies within brands that are inherently quite different. But also specifically on new product development within the group. And if you have a few examples of how you're bringing the different parties together and what the end product of that is, and how that might contrast with what was happening within the group, say, 3 years ago.
I think what we are doing is we're working a lot closer together on MPD. I think one of the leadership flagship projects is working together on finishes. You'll have seen kind of blacks, whites, rose golds, brush bronzes. All of those are slightly different under different lights, but by bringing our businesses together, they can be exactly the same to be colour matched in a finished bathroom. So that would be one area. Another area might be in operational resilience. Our Grant Westfield business, particularly strong in IT and cyber security. So bringing those expertise and spreading that back out to our sister companies, that's also been very beneficial as well. So we're coming together on new product development, operational improvements, and I'm sure Thomas has got even more examples. I know.
No, I have. There's this untapped well of opportunity within the group without changing, our core decentralized nature, and the fact you're starting to see operating margins change and us growing share ahead of many competitors is really the evidence of what we're doing in those areas. But I think matching bathrooms is critical. One of our key customers is Wicks. And we work really closely with them in terms of helping them remain relevant. And we're able to do that when you walk into a new Wicks store. You've got proper room sets. So you can imagine us taking a Grant Westfield panel, a matching Merlin shower enclosure, and a Vardo shower valve and shower head that all work really well together. So, we're positioning our customers, and because at the end of the day, the better our customers do, the better we do. So that's an area that will continue to develop, Andy.
I think another just an add-on to that as well would be in terms of that new product development. We'll just come back to the Triton example and that MV shower. That was a conscious decision by ourselves and the management team 18 months ago to invest. And it was a reasonable amount of money, as you might expect, but that has driven the market share gains that we're seeing now. And I don't know if Thomas mentioned, but in H1, in these results, Triton grew volumes in the first 6 months of the year in what has been a tough market. And I think that speaks volumes about, no pun intended, that speaks to what new product development does and your ability and our ability to take market share.
Yeah.
Okay, well, I won't ask whether James's new bathroom is going to be used as a showroom going forward, but I'm sure it's well stocked with high quality products. So.
Absolutely, definitely is.
Right, we've got a few questions on M&A, but I'll just slip in a pension one, which I assume I'll look in your direction here, James. You've got a nice DB surplus now. So what are the chances of the liabilities perhaps in the future being sold on to an insurer or other manager?
It's something that we are actively working on in terms of what is the optionality, what do we have to do to get the buyout, to get the pension in the best possible shape, to get the best possible insurance pricing. That's probably at least 12-18 months off, because there's quite a bit of admin involved behind the scenes on that, not least with GMP equalisation, which we don't have to go into detail on, but that's a considerable amount of work. Having said that, we're also cognizant that whenever we potentially do get a quote from an insurance company, there's going to be 20 to 30 million pounds of profit margin in it for them, in which case it may not be an appropriate use of our capital to take the pension off balance sheet. I think the point being there is we've got options. It's in a great space, the pension scheme. It's light years away from where it was 3 or 5 years ago. We're in accounting surplus. We've got a really collaborative trustee relationship. We work really well together. We understand the strategy, back the strategy. So we're in a good place, and the pension doesn't distract us strategically at all.
Yeah, you've got to assess it at the time, and as you say, anybody who's going to buy an asset is looking for a return on it. So it could well be, best left to run its course under your own management. So we shall see with that. Right. Lastly, a few on M&A, and perhaps you could give a little idea of what the upper scale limits might be for your capacity to buy an attractive asset, and what are the board's sensible leverage limit controls around that.
Well, let me try and pick that up on the structure. And I guess in terms of size of transaction, you've seen we did the largest transaction, Grant Westfield, which was 80 million last year. We've certainly looked at things bigger than that, and we certainly look at things smaller than that. I think from a structure point of view, it depends on what that kind of financial structure looks like. I think we're very cognizant of where the share price is at the moment, raising equity. We have to be very careful about that. But if a deal is strategically compelling and we can structure something sensibly that's earnings accretive, we'll take that to shareholders. Having said that, with leverage, just to be clear, we have a very conservative approach to leverage. Yeah. We'd take leverage up to 1.5 times, 1.75 times at most. We've seen us do that historically, and then the cash generation means that leverage comes down. So I think we've got an active pipeline. We're looking at lots of really interesting, exciting businesses, some of which may be a bolt-on and all debt, some of which may be a little bit more significant, but it's got to make sense and it's got to work from a financial returns point of view.
Quite right too. And in terms of that sort of pipeline, which has been around for a while in terms of opportunity, can you just add a little more color about how the pipeline itself is changing? Are there competitors taking businesses away from that? Are new businesses coming onto your horizon? Is there much flux in the market at the moment?
I think all the time that pipeline, there'll be someone there that's been there several years, from businesses that we've known and followed and really get to understand and know owners who just aren't ready to sell yet. There'll be businesses on there that are in an auction process with private equity sniffing around, etc. And there'll be other businesses that are totally off market that will be looking at because the owners don't want everybody going through their numbers and their commercially sensitive data. So all the time deals will come in and all the time deals will come off. But I think what I would say is, as a business, as Norcros, we know the market better than anybody else. Over the years I've been here, which is 10, we've seen hundreds of IMs. We know the business, we know the people, and we're seen as a really good home for our acquisitions. So we've got a really solid reputation. We're not going to do 2 deals a year and go crazy. Our deals are sensible, lots of due diligence, and we bring things in that make sense.
Okay. And then in terms of targets, we have a question. Would geography be a major driver, or is that just one component of what you would regard as an ideal strategic fit?
I think overall, the majority of targets are in the UK, but equally we see near coast Europe as potential. There's some attractive markets there, like Scandinavia. Historically, well, we've operated in the Middle East, so we've looked at businesses there. And as far afield as Brazil, which has the largest electric shower market in the world. I don't think we're going to buy anything in Brazil anytime soon, but it just gives you a flavour of the international element of what we're looking at. And we want to make sure we understand the global market for our products.
Okay, and obviously not everybody is faring as well as you are at the moment. We've had the administration of Victoria Plumb recently in the UK. So we have a question: would you also look at assets and businesses being sold at distressed valuations, or is again the ultimate arbiter of a acquisition going to be strategic fit?
Yeah, we don't major on turnarounds. We may pick up brands or specific parts of distressed businesses or businesses that have closed, but we like to take on strong existing management teams and businesses with, really good market positions and really strong growth prospects. Our Wilmslow central office, I think, has 15 people in it, so we don't have the bandwidth to be turning businesses around, and we think there's easier ways of, finding good businesses at the right value and using them to grow themselves just by supporting them financially, and as we showed, introducing them to our sales channels. So our focus would be there.
Well, that's great. To anybody whose question hasn't made it through, do let us know, and we'll forward it on to the management. But thank you very much to the audience for some very, very interesting, diverse questions. A reminder for those who joined a little late that this slide deck that Tom and James have been using is available on the Norcros website, as is our initiation piece, very detailed piece written by Toby Thornton last week, which had a 233 pence fair value, which you're a little bit nearer to now, Thomas, than last week. So we hope that journey continues. Thank you on behalf of all of the audience to Thomas and James for a very enlightening presentation.
Thank you for your time, guys. Have a good day. Bye-bye.